Hi friends, in this video I'm going to explain to you about the application of an Excel nested if function along with the utility of absolute referencing and relative referencing in such scenarios. Let me make use of an Excel sheet that has been prepared for computation of income tax in relation to your project. As you can see here, uh, the table is on computation of income tax and the particulars are given profit before tax, then taxable income. I'm not going in detail about the concepts behind the computation of tax. However, I just need to mention here that taxable income for a particular year would be something which need not necessarily be the profit before tax that is being computed because the profit before tax is subjected to many adjustments on account of reliefs, rebates, add backs, etc. So, so that on that basis, after making all such adjustments, the taxable income is computed. One of the key adjustments which we have considered for the purpose of illustration here is on account of the loss that has been suffered by the uh, business in the previous year or previous years. Fine. Okay. So now you can also, so there is a row for computation of taxable income. Our focus is on the formulae which have been entered in this in relation to this particular row. So then, so if you look at your the basic tax rate is there, then you can look at something called surcharge rate. Surcharge rate is something which is a percentage of the basic tax rate. It is not a percentage that is applicable directly on the taxable income. Rather, it is a percentage that is applied on the basic tax rate. So based on that, the gross surcharge is just 0.9 percentage of the uh, basic tax rate. Fine. Okay. 0.9 percentage. In fact, it's not 0.9 percentage of the tax rate. 0.9 percentage is added to the basic tax rate. So that takes us to the gross tax rate of 30.9 percentage. So then accordingly, this rate is being applied for calculation of the tax. And you can see zero for the first 2 years. Then there are taxes that have been computed for the rest of the years. Fine. So in addition, I just also need to mention the basic tax rules, which are more or less of the same nature across the jurisdictions. If a business entity is subjected to tax on its income. So generally, the if the particular year's income is nil or negative, no tax is payable for that year. If the sum of the businesses might also be incurring losses. So if losses are being incurred, the business entities are given a relief on by way of adjustment or known as set off against the profits earned in the future years. Okay, so at any point of time, the cumulative, if the loss had been incurred by the business entity in the earlier years, there will be um, accumulated and carried forward for set off. And so, if the previous years historically there have been losses, so those losses will be carried forward and set off for a particular limited number of years against the income that will be earned. Okay, so if the amount that has been carried forward, if the loss that has been carried forward um, within the time limit, within a particular time limit, and if a particular year's future year's income is positive, then the loss will be adjusted. So even if after adjustment, if still there is a negative, then no tax is payable as well for that year. And if the losses of previous years, when you add it to the current year's income, so the losses might have been completely set off, uh, and a positive income will be left. That so to the extent of the positive income that has been left, the tax will be calculated also. So these are all the kind of generic rules that will be followed in most of the jurisdictions across the globe. Now coming back to the application of this the nested formula. Now just look here. So if I just take you, let me take you to cell B6. Okay, you can, here we are using if R. Okay, and nested ifs also. Okay, there are now, as I told you, the first formula is what? If the here, if the profit before tax is negative, then no tax is um, applicable for that particular year. Okay, so like that now. Uh, so now I need to incorporate all the possible scenarios. That is, this one is, if it is negative, then this will be 0. If the sum of these two is negative, then this will be 0. If the sum of these three is positive, but the positive amount is lesser than the value in this column, then the tax is calculated on that particular amount. So you need to calculate and compute that specific amount on which the tax is payable. And if there are no losses which are remaining to be set off, then the tax is calculated on the entire uh, amount of profit before tax. Okay, and look at the formula here. So if B5 is less than 0, I mean this one is less than 0, then uh, sum of these two is less than 0, then also in these two scenarios, then the taxable income will be 0. That is how you can look at the formula. Okay, and in this case, if you look here, the sum of B5 to D5, it is positive, but that sum is the positive sum is lesser than the 17.69. So the taxable income is calculated accordingly. Fine. Okay, so look here. So these are the three scenarios we consider. In fact, four scenarios. This one is less than 0. If these two sums are less than 0, then if all the three sums are, if you add all the three sums, I mean the profit before tax, then there is a positive which is lesser than the uh, profit for that particular year. Then the tax is calculated accordingly. If you have any questions, you may just put it as a comment. I can get back to you on this.